Hello everyone, and welcome back to the channel. Today, we're diving deep into two powerful trading strategies that can seriously level up your game: breakouts and fades. Whether you're a seasoned trader or just getting started, understanding when and how to use these techniques can be the key to unlocking more consistent returns. So, grab a coffee, get comfortable, and let's get into it. First, what exactly is a breakout? Imagine a stock has been trading within a predictable range for a while, bouncing between a specific high, called resistance, and a low, called support. A breakout happens when the price finally breaks through one of these levels with significant momentum. Think of it like a dam bursting. All that pent-up energy is released, and the price often continues to move strongly in the direction of the break. So, how do we trade a breakout? The core idea is to identify these consolidation patterns like ranges, triangles, or flags and wait for a decisive move. A key indicator to watch for is volume. A true breakout is almost always accompanied by a big spike in trading volume. This surge in volume confirms that there's real conviction behind the move, not just a random fluctuation. Without that volume confirmation, you might be stepping into what's called a false breakout or a fakeout, which is a classic trap we'll talk more about later. Let's walk through a classic breakout scenario. You've identified a stock trading between $50 and $55 for the past 2 weeks. The $55 level is your resistance. You set an alert for when the price approaches $55. Suddenly, the price pushes through $55.20, and you see the volume on your chart spike to 3 or 4 times its recent average. This is your signal. A common entry strategy is to place a buy order just above the resistance level, say at $55.25. But where do you place your stop loss? This is crucial for managing risk. A logical place for your stop loss is just back inside the previous trading range, maybe at $54.75. This way, if the breakout fails and the price falls back into the range, you're out of the trade with a small, manageable loss. Your profit target can be determined by measuring the height of the previous range in our example. That's $55 minus $50. You could then project that distance from the breakout point, giving you a potential target of around $60. This gives you a clear risk-to-reward ratio. Now, let's flip the script and talk about the opposite strategy, fading. Fading is a contrarian approach. Instead of trading with the momentum like in a breakout, you're betting against it. Faders look for moments when a price move seems overextended and likely to reverse. Essentially, you're buying into weakness or selling into strength, anticipating a pullback. Fading a breakout means you're betting that the breakout will fail. You've seen the price push through that $55 resistance, but instead of jumping on board, you're skeptical. Maybe the volume isn't that impressive, or maybe the broader market is showing signs of weakness. You believe this is a false breakout, a bull trap designed to lure in eager buyers before the price reverses. So, how do you trade a fade? In our example, as the price breaks $55 but struggles to gain altitude, you might decide to short sell the stock at, say, $55.30. Your bet is that the price will fall back below the $55 resistance level. Your stop loss would be placed just above the high of the attempted breakout, maybe at $55.70. If you're wrong and the breakout turns out to be real, your loss is contained. If you're right and the price tumbles back into the old range, you can target the previous support level around $50 for a very profitable trade. Fading can be incredibly rewarding because false breakouts happen all the time. They're often caused by institutional traders trying to trigger stop-loss orders from other market participants. By learning to identify the signs of a weak breakout like low volume, bearish candlestick patterns right after the break, or divergence on indicators like the RSI, you can position yourself to profit from the reversal. So, which strategy is better, breakout or fade? The truth is, neither is inherently superior. They are two different tools for two different market situations. The best traders are flexible and can use both. Your choice depends on the context of the market and your personal trading style. If you prefer trading with the trend and have a higher tolerance for fast-moving markets, breakout trading might be your speed. It's about catching momentum and riding the wave. Breakout trading often works best in strong, trending markets where conviction is high. Think about a hot sector where every stock seems to be pushing to new highs. That's prime territory for breakout strategies. On the other hand, if you're more of a contrarian who enjoys analyzing market psychology and identifying turning points, fading might be more your style. Fading requires patience and a strong stomach, as you're initially trading against the immediate price action. It tends to work well in choppy, range-bound markets where moves often run out of steam in reverse. To really maximize your returns, the goal is to become proficient at both. Start by focusing on one. Paper traded. Get a feel for the setups, the entries, and the risk management. Study charts and identify past examples of successful and failed breakouts. What did the successful ones have in common? What were the warning signs for the failures? A powerful technique is to combine these strategies. For example, you might try to trade a breakout but get stopped out. Instead of getting frustrated, you can immediately switch your mindset. Was that a false breakout? If so, you can re-enter the trade in the opposite direction and fade the move back into the range. This adaptability is what separates good traders from great ones. You're not just blindly following one rule. You're reading the market story as it unfolds and reacting accordingly. Let's summarize the key takeaways. Breakout trading is about capitalizing on momentum when a price breaks a key level, confirmed by high volume. It's a trend-following strategy. Fading is a contrarian strategy where you bet against an overextended move, anticipating a reversal. This is often used to trade false breakouts. Your success with either strategy hinges on three things. First, a solid plan. Know your entry point, your stop loss, and your profit target before you ever place the trade. Second, disciplined risk management. Never risk more than a small percentage of your capital on a single trade. This ensures that a few losing trades won't wipe you out. And third, continuous learning. The market is always evolving, so keep studying, keep practicing, and stay humble. I hope this breakdown of breakout and fading strategies has been helpful for you. They are fundamental concepts, but mastering their application takes time and practice. Start small, focus on high-quality setups, and always prioritize protecting your capital. What are your experiences with these strategies? Do you prefer trading breakouts or fades? Let me know in the comments below. I read every single one and would love to hear your thoughts. If you found this video valuable, please hit that like button, and be sure to subscribe and turn on notifications so you don't miss our next deep dive into trading strategies. Thanks so much for watching, and I'll see you in the next video.